What was the link? Link regarding what? Link Google Drive का link check करना. Or the presentation which I have given to the similar presentation which people have given. हाँ वो ठीक है वो मैं share कर दूँ. So that I can just upload. Because I keep getting so many messages and teaching so many students को कहता है मेरी attendance नहीं है कोई बोलता है ये नहीं है कोई कहता है ये share कर दो. Somebody is asking me, whether the letter of credit, the rules regarding letter of credit from the international foreign trade. So that guy was kept on asking me some questions. So I was, kept on replying. I couldn't do anything for you people, so I couldn't share anything. So let's go to the. Now what is happening? This lecture is getting recorded, okay? And the students who have not, because अगर मैं सुबह record कर लेता तो this has been all available to the students who have missed out. So, but I have recorded some of the lectures. The last lecture which I gave for the BMS students, which contains some of the topics which are relevant for you. So I'll share that. Okay, so you can watch there. So now I have to sit because otherwise my voice will not get recorded. Okay, properly. So exit opportunity to dissenting shareholders. So the company has issued an IPO, and they have advertised the main objects of the IPO, from where for where they will be spending their money on which components of whether they'll be investing in assets or they will be repaying some of their loans. Okay, now if the company has diverted their funds to certain investments which were not mentioned in the main object of the prospectus or a red herring prospectus, then some of the shareholders can dissent. Okay, and so the company has to take care of them. Company has to either return the money to them or whatever. So we'll just understand that. Let's just read.
What is dissenting shareholders?
So who are the dissenting shareholders and what is dissenting shareholders?
Dissenting shareholders.
Come here so that your voice also gets recorded. Okay, side by side. I can always edit my file and remove the time you have taken to come here, so I can remove it so it will get. Okay.
Dissenting shareholders mean those shareholders who have voted against the resolution for change in objects or variation in terms of a contract referred to in the offer document of the issuer.
So dissenting shareholders or dissenting mean those shareholders who have voted against the resolution for change in objects or variation in terms of the contract. The company has advertised in their prospectus or the offer letter that they'll be using all the money which they are going to take it from either from an IPO or an FPO, where it will be being used. Of course, this is other than offer for sale, because offer for sale, the money will not come to the company; it will go to the shareholders. So this clause is not applicable there. Only for the fresh issue of money which the company is going to get. If the company is going to use it for any other purpose than what was mentioned in IPO, so or there is any variation in terms of the contract, then the issuers can pass a resolution, a special resolution in the company. Okay, let's talk about that.
Conditions for exit offer.
So these are the conditions for exit offer.
The promoters or shareholders in the control shall make the exit offer to the dissenting shareholders if the proposal for change in objects or variation in terms of a contract referred to in the offer document is dissented by at least 10% of the shareholders who voted in the general meeting.
So company conducts a general meeting, and if there are dissenting shareholders, if there should be at least 10% people who should actually dissent. Okay, then only the company can take an action. The promoters or the people who are the manage the company. So at least 10% should dissent. Then this exit opportunity should be given to these shareholders. Okay. Okay, so that's all. So this is regarding this. Of course, it contains so many other things which are you can just read it for your further understanding. What exactly is given to the exit, how these dissenting shareholders, what kind of relief is given to them. You can always check back in the ICDR regulations. Now we come to the preferential issue applicability. Now I told you that company can issue a preferential issue also, okay, or a QIB issue. So let's talk about the preferential issue. To whom it is applicable? Yeah.
Preferential issue means an issue of specified securities by a listed issuer to any select person or group of persons on a private placement basis.
So company has to raise money. Okay, company can go to the public, IPO or FPO. Now company can also make an preferential issue. Instead of going to the public to all the kinds of categories of people which have been there, like the QIBs, the employees, and I mean NIs, RRIs. So company can issue only a select people. Okay, fine. Some two or three people who has a lot of money and they want to invest into a company, so company can come with a preferential issue. Okay, and only choose pick and choose those people and ask them to contribute that money, and those people will be given shares in lieu of the funds they have given to the company. So this is called a private placement. Okay, so this is basically a private placement where you just offer shares to only a select few. Okay, company will decide who are these people. Okay.
A listed issuer may make a preferential issue of specified securities if, first, all equity shares allotted by way of preferential issue shall be made fully paid up at the time of the allotment, and second, a special resolution has been passed by its shareholders.
Okay, so there are two, conditions here that, all the shares which are fully paid, partly paid up, they should be made fully paid up before the allotment happens. Second, a special resolution has been passed by the shareholders. So the shareholders should authorize the company that they can raise the money by way of private placement. So at least 75% of the people, if they agree, the shareholders, by passing a special resolution, then only the company can come with a preferential issue. Okay.
Third, all the equity shares, if any, held by the proposed allottees in the issuer are in dematerialized form.
Okay, so this has to be in demat form. All the shares will be issued has to be in demat form, even the private placement. Okay.
Fourth, the issuer is in compliance with the condition for continuous listing of equity shares as specified in the listing agreement with the recognized stock exchange where the equity shares of the issuers are listed.
So there is a listing agreement which is done by the company with the stock exchange, and there is a listing regulations also issued by the SEBI. So the issuer should comply with all the listing conditions. Okay, and with the stock exchange. Now there is a listing. I still told you that LODR, which is basically the listing regulations issued by SEBI. We are not doing them in our this term, so you can always read them. I mean, once you have understood what is ICDR, it's very simple to understand those also.
Fifth, the issuer has obtained the permanent account number of the proposed allottees.
So the issuer has obtained the permanent account number of all the allottees who are going to be issued shares for preferential issue. So a company should collect the permanent account number of those allotted. So this is, I think, all for the private placement. Okay. For further reading, you can go to the ICDR and read something else also which is written. Qualified institutional placement. Okay. So instead of going for a preferential issue, company can even issue shares to the QIBs. Okay. Those 13 entities which have been, all these entities need to be registered with the SEBI. So company can come with an issue which can be just for the meant for QIBs.
Qualified institutions placement means allotment of eligible securities by a listed issuer to qualified institutional buyers on private placement basis.
So this is done on private placement basis only for QIBs. The first one is that one was private placement, which is can be, company can decide to issue to anyone. Okay, fine. Here the company is issuing only to the QIBs which are registered with the SEBI. Fine. So that's the difference between the private placement as well as the QIB placement. Okay.
And includes an offer for sale of specified securities by the promoters and or promoters group on a private placement basis.
So the company can also, the existing shareholders can also offload their own existing shares through the QIB process. Okay, through a private placement taking place through QIB.
Eligible securities include equity shares, non-convertible debt instruments along with warrants and convertible securities other than warrants.
So company is free to issue either shares or convertible debentures, and they can even issue warrants along with the securities or a debt instruments. So company is free to issue anything to QIB through a private placement, whether they can issue fresh equity shares, they can issue convertible debentures, they can issue warrants, debt instruments with warrants, the non-convertible debentures along with warrants, or simply the warrants, convertible warrants also through this process. Okay. Now we come to this is all for what we have done for the QIBs. Okay. Qualified institutional placement. So we have done the private placement as well as qualified institutional placement. So there is something more also which we can always refer to the ICDR. Now we come to issue of specified securities by small and medium enterprises. So there are some companies which are considered to be small and medium enterprises. So they can also issue shares. Okay. For that, what is there?
SME exchange means a trading platform for an offer-recognized stock exchange having nationwide trading terminals permitted by SEBI. This is specified securities issued and includes a stock exchange granted recognition for this purpose but does not include the main board.
So, most of the companies use the main board, which are big companies. Okay. But small and medium enterprises, they have one more window. Rather, they have a window where they can list the shares, not through the main route, not through the main road, but they can go to the SME exchange and get their shares listed on this exchange. Okay. So this is another version of the stock exchange. So I told you there are three versions. One is called the SME exchange, another is called the main board, and the third is the IGP platform. Okay. Fine. Fine.
Eligibility requirements for an initial public offer. First, if the issuer's post-issue paid-up capital is less than or equal to 10 crore rupees, then list only on SME platform of the exchange.
So basically, those companies which have a post-issue paid-up capital which is less than 10 crores, either equal to or less than 10 crores, after they make a issue, their capital will still, be within a 10 crore rupees bracket. Then these companies can get their shares listed on a SME platform or an SME exchange of the platform of the exchange. Okay. So this is a platform which is given on the stock exchange. Okay.
If post-issue filing capital is more than 10 crore and up to 25 crores, then listing on SME platform of exchange is optional and a company may opt for listing on the main board of the exchange also.
So if it is the capital, is more than 10 crores, but within 25 crores, then they can, they have an option to go to the main board, or they can even choose to be on the SME platform. Okay.
If the issuer satisfies track record and or other eligibility conditions of the SME exchange on which the specified securities are proposed to be listed.
Okay, so that means the issuer should comply with the track record. So we'll understand what is track record and all the eligibility conditions, that we have all studied. So this needs to be met before they can go to the SME exchange. Okay. So now we come to the fast track, okay, the track record we're talking about. Now, this is called a fast track FPO. Normally, a company needs to, go to SEBI and file a draft offer. Okay, the SEBI takes its time, almost like 30 days, I mean, to grant the permission for the company for, clearing the offer document. Okay, and it may even get delayed if suppose there are some observations, the SEBI has. So this fast track FPO, this is fast track FPO, not an IPO. Okay, so this is already a company which is listed on the stock exchange. Okay, and it has a track record. Track record means it contains a lot of things. Now, companies, legally compliant. There is no legal, issues which are pending on account of SEBI or something. So those companies will be, and they are complied with all the regulations, and the shares are listed, and there is a required amount of turnover they are maintaining on the stock exchange. Then those companies can actually issue the shares without being first, giving an offer document to SEBI. Number one, they don't have to give even a deposit, 1% deposit to the stock exchange. Okay, so there are some relaxations which are given to some companies, which are big companies, okay, which are complying, which are legally more compliant. Okay, and let's understand one by one what are those companies which can go for a fast track.
An issuer company, if they are already listed, need not file a draft offer document with SEBI and obtain observations from SEBI or make a security deposit with the stock exchanges for its follow-on public offer, that is FPO, if it satisfies the following conditions.
So there are two kinds of concessions which are given. One is that they need not file a draft offer document with SEBI. Okay, and they are also, they get advantage of not paying a security deposit to the stock exchange. Okay, yeah.
The equity
So that means those equity shares should be at least listed on the stock exchange for 3 years. If company which is already the shares are listed and 3 years are over, they can. The first condition is that this should be met by a company. Second,
Second, the entire shareholding of the promoter group of the issuer platform on the reference date.
okay, so that means the promoter share should be all in dematerialized format. Okay, entire shareholding of the promoters group of the issuer is held in dematerialized form on the reference date. If this is met, this is the second condition. Okay.
Third, the average market capitalization of public shareholding of the issuer is at least 1,000 crore rupees.
So the market cap of more than 1,000 crores, those companies who are having a market cap of above 1,000 crores are eligible for fast track. Okay, so there are some companies which have, some companies don't have. So companies which have lower than 1,000 market cap will not be eligible. Okay. Okay, just hold on. Yeah, D.
Fourth, the annualized trading turnover of the equity shares of the issuer during 6 calendar months immediately the month of the reference date has been at least 2% of the weighted average number of equity shares listed during such 6 months period.
So in nutshell, that means the annualized trading turnover of this company should be at least 2% of the weighted average of the number of equity shares listed on the stock exchange. Okay, if suppose the company has 100 shares which are listed on the stock exchange, and if suppose 5 are traded, so that means 5% shares are being traded on the stock exchange. So it is meeting the criteria. Okay, so at least it should be 2% of the weighted average number of equity shares listed during the 6 months. No, shares may issue more shares, so it has to be taken the weighted average during this whole 6 months process. What is the weighted average? That has to be considered. Okay.
Fifth, the annualized delivery-based trading turnover of the equity shares during 6 calendar months immediately preceding the month of the reference date has been at least 8% of the annualized trading turnover of the equity shares during such 6 months period.
Now there's a 2% and 10%. 2% means the trading, which includes both future and options as well as the cash buying. When you go to the stock exchange, you can either buy shares in a cash by paying cash, and the shares will come into your demat account. So that is one window. Second is you go to the futures and options market, and you can just trade, and you can either take a long position or short position without holding the shares. Okay, you don't have to pay the entire money in one shot. You have to pay a margin money. So, I mean, put together, all the trading volume should be at least 2%. But for delivery based, which is the cash segment of the market, then the turnover should be at least 10% in the last 6 months. Is that clear? Fine. Yeah. Should I explain again? Now, suppose if you have to buy, for example, you have to buy a share like Reliance. Reliance is trading at 2,600. Now, if you are a long-term investor, you will buy a Reliance at, say, 100 shares at 2,600, which will be around 2,60,000. So you will pay the entire money, okay, and buy it. Book an order. You have to pay immediately the entire money. If you are using the cash segment, okay, of the market, you can buy it, and that share will come to your account in your demat account, and money will be taken out from your bank, okay, and you will have the shares, and you can hold the shares for any time you want. Okay, you can sell them after 1 year, 10 years, or you want to hold it for a long-term investment or short-term purpose. That will be your own choice. So that is one way. So that is called delivery based. You're taking a delivery, and the share is coming into your demat account. Second is that instead of going to the cash segment of the market, you go to the future segment of the market, where you can take positions in futures and options of the market, where you place an order in a particular month. Like at any given time, there are 3 months which are open on the stock exchange. Like suppose now it is November. So November, December, January. So there will be 3 months contract will be open. So you can take any position of Reliance in any month. Suppose you take position in January, you expect the Reliance to go up. So you're going to take a long position in Reliance and buy 100 shares of Reliance, okay, in the month of January. So you get a right to buy shares, 100 shares, okay, a contract that you are going to purchase 100 shares at so and so, even the price is fixed, okay. Suppose you have fixed a price of say 2,600. Fine. So you get a right to buy those shares at 2,600, okay, in the month of January, on or before the close of the January. Now, if the share goes to 3,000, you're sitting on 400 rupees profit. But before when you enter, you have to pay a margin money. which may be 20% of the entire amount. So instead of paying 2,60,000, you pay only 52,000 rupees upfront as a margin money to the stock exchange, and your order will be placed. Okay, then the share price, if it goes up, since you have taken a long position, you will be making money. If the share price goes down, that means you are losing money. But you can always dispose of this contract anytime before before the expiry of January. Suppose you wait till January and the share price touches 3,000, so you're sitting on 400 rupees profit. So you'll get 400 rupees profit. Okay, not the shares. So this is basically the trading which happens on the stock exchange. Okay? You can always sell off the shares. If you bought them at 2,600, it goes to 3,000, say in December. You can even sell in December by taking just the opposite position, by taking squaring off your position, and still make your money well before January. Okay, maybe in January it touches 2,300, but you have already exited from the option position, future position, so you have encashed your profits. Have you got it? So that means the annualized turnover for entire trading, which considered the cash as well as the future on option, is 2%. For only the delivery based, it is 10%. Okay, because the delivery based transactions are very less. Even when you look at the total, the bifurcation between the cash market and the future on options, the future market will be like 70 to 80 times or maybe 90 times more than the cash market. Okay, suppose 100 crores transaction happened, 5,000 crores will be for the cash market, and 95,000 crore will be the future on options market on any given day. It's that kind of 5% of the total share. Okay, read the F1.
Six, the issuer has been in compliance with the equity listing agreement or SEBI listing agreement with the 15 as applicable for a period of at least 3 years immediately preceding the reference date.
So that means you should comply with the listing regulations which are issued by the SEBI. 2015 is like ICDR 2018, what we are currently understanding. So there is a SEBI listing regulations 2015. The company has been complying with this listing regulations for a period of at least 3 years immediately preceding the reference date. So before you come with an FPO, so you should be complying with the listing regulations for at least 3 years. Okay, fine. So listing regulations are also a lot of clauses there, so you can just go through them. Okay, like for example, there is a clause 49 of the listing agreement which talks about the corporate governance, that how many independent directors you should have in the board, who will be the chairman, who will be the executive chairman. So all those, and there should be a woman director. So there are many clauses. Okay, so you should, if you have met them continuously for the last 3 years and you have complied with all other conditions of the SEBI listing regulations, then you are eligible for fast track IPO. Okay, yeah.
Seven, the issuer has redressed at least 95% of the complaints received from the investors till the end of the quarter immediately preceding the month of the reference date.
So the another one is that you have at least addressed 95% of the complaints which you have received from the investors. Okay, so if you have met that, then you can go for a fast track, but it is to be within the specified time frame which is mentioned in the head. Okay.
No show cause notices have been issued or prosecution proceedings have been initiated by the board and pending against the issuer or its promoter or full-time directors as on the reference date.
So there should not be any no show cause notice should be there. Okay. So the SEBI can issue show cause notices to the company. Okay. So there should be no show cause notice which is pending. Okay. Or no prosecution proceeding have been initiated by the board against your company or which is pending. So if that is not pending, then you can go for a fast track IPO. So you know what is show cause notice?
If there is any observation found.
So explanation can be sought from you. Okay. Before, when I was working with various companies, so we used to get a lot of show cause notices from GST, authorities or from excise authorities. Okay. Before they, levy any kind of, take any demand or any kind of, confirmed order against you. So they'll give you a show cause notice. Okay. And then you have to appear and give replies and file replies. And then they can either drop the show cause notice or they can, prosecute you or, levy some penalty or raise a demand against the show cause notice. That's a process. Okay. Alleged violations.
alleged violation of securities law through the consent or settlement mechanism with the board during 3 years immediately preceding the reference date.
Okay, you should not have settled something, some kind of a, for example, the issuer, the promoter, or the group or director of the issuer has not settled any alleged violation through the SEBI. You should not have gone for any settlement mechanism and settle. Of course, some kind of a shown cause notice was issued, and you have gone for a settlement process. Okay, you accepted that you have committed some kind of a breach, and you have settled it by paying some penalty or fine. So you should not be, at least 3 years immediately preceding the reference date. There should not be any settlement which has happened through SEBI of any of the, thing which you have. You have accepted the breach of any violation. Okay.
Equity shares of the issuer have not been suspended from trading as a distinguishing measure during the last 3 years immediately preceding the reference date.
So that means the share should not have been suspended by the stock exchange, okay, in the last 3 years. If that has not happened, then your company can go for a fast track.
There shall be no conflict of interest between merchant bankers and the issuer or its group or associate company in accordance with the applicable regulations.
So there should not be any conflict of interest between the merchant banker and the issuer, so that the merchant banker is not, being was an employee or somebody in past. So we have to look for, if there is any kind of a conflict of interest. If there is no conflict of interest, then the companies can go for an IPO.
Impact of audit qualification, if any, and where quantifiable, on the audited accounts of the issuer in respect of those financial years for which such accounts are disclosed in the letter of offer does not exceed 5% of the net profit or loss after tax of the issuer of the respective year.
Now, whenever the audit takes place and the auditors check your books and account, they give you an annual, report, audit report. Now, there can be an audit report which says the company has, met all the norms, and they say that, it gives the true and fair picture of the position of the company. So they can give a clean report without qualifying it. Now, they can always qualify it also. They can subject to all this. The report is, it looks to be true and fair, but these are the points which I'm mentioning. Okay, they can qualify the audit report. Now, they, for example, they could not even, check the stock. They could not do the verification of the stock because, they were not allowed to do it, or they could not get the debtor's confirmation. Okay, like there are so many things which the auditor is supposed to do, and if they could not do it because the company didn't cooperate, so they can say that subject to all this which they have not checked, everything is okay. Okay, but all this, if it counts to be less than 5% of the total profit of the company, the stock is just 1 crore and company is doing a net profit of say 1,000 crores, then it is not material in nature. Okay, so in that case it will be allowed. So it should not be, those objections or those qualifications should not exceed 5% of the net profit or loss of the company. Is that okay? So all those audit qualifications should be very small and minor in nature, should not impact more than 5% profit of the company. Okay, they are negligible or they are not so material, then the company can go for a fast track IPO. Is that okay? Okay. Now, this is what about fast track IPO. There's something else also which you can read in the ICDR beyond this. So I've just given you this thing. Who are the companies who are eligible? Okay. Now, with regard to pricing and other things, there are a lot of other, things which are mentioned. It will become a very big, kind of a thing if you have gone through everything. Okay. So let's understand now what is SR equity shares. Now, this is very important. Okay, and very interesting, and there will be a question definitely from SR. So SR equity share means the equity shares of an issuer having superior voting rights compared to all other equity shares issued by that issuer. So these shareholders are given, superior voting rights. For example, a person is holding 1 share will get 2 voting rights. Normally, one shareholder, 1 share means 1 voting right. So they can be given more. Okay. Now, there is something called, Companies Act differential voting rights. There's a, law in 2013. DVR. Okay. So some people can be given inferior voting rights, and some shareholders can be given you know, superior voting rights.
So these shares can be traded in the public or not? Tata Motors DVR.
No, वो DVR तो है, Tata Motors DVR तो है, but SR equity shares cannot be traded because they have to remain with the promoters or the company person who has been given. So they are going to manage the company, okay? So they can't sell. The moment they sell, they lose their rights. The superior voting rights are gone. Okay, we'll understand them. Okay, read.
Provisions for SR equity shares. The issuer shall be intensive in the use of technology, information technology, intellectual property, data analytics, biotechnology, or nanotechnology to provide products, services, or business platforms with substantial value addition.
No, this provision is applicable only to the companies which are, they are using extensively the technology, okay, intellectual property data analytics, okay. All these companies which are mentioned here, these companies, I mean, some shareholders will get this superior voting rights, okay. Only the SR provisions of SR equity shares are applicable to such companies. For example, Tata Motors, they will not get, special voting rights to their directors. But a company like Zomato or Swiggy, where a lot of data analytics are, being dealt with, so the directors of those companies can be given superior voting rights because, first of all, those people have, all the information and they have, all the expertise, okay, and that's why, those for preserving those people in the company so that they don't leave out or they don't exit from the company, so they are given superior voting rights, okay, and so these are only given to such companies like, for example, Zomato or Swiggy, because they have a lot of data, so they can even help you basically to, if you're going to start a restaurant business, okay, and if you want to know which, things which are being used by which places, what kind of dishes which are being more ordered, say for example, say Shivnadar University campus, somebody wants to start, so they'll find out, what students are, demanding, so, and they can tell you that such kind of things will do well if you open your services near the Shivnadar University. So they will give you.
Insight generation.
Yeah, absolutely. Because suppose people are more from Maharashtra and South who are in Shivnadar. So those kind of dishes will be. They'll say, okay, you if promote those, then you will do well. Okay. So these are the companies which are only allowed the special, or rather, the voting rights, superior voting rights. Okay. Now read further.
The superior right shareholder shall not be part of the promoter group whose collective net worth is more than 1,000 crore rupees.
Now, it is only meant for small promoters, startup promoters, companies which are having promoters which are managed by the promoters which are not very big. Okay. So if your net worth is more than 1,000 crores, the promoters or the promoter group, okay, you belong to that person, then the superior voting rights will not be given to you. It is only meant for uh, the people whose net worth is less than 1,000 crores.
The superior voting rights shares are issued only to the promoters or founders who hold an executive position in the issuer company.
So that means you should be a promoter, okay, or a founder. If you hold an executive position, you are the managing director of the company or chief marketing officer or the chief human resource officer, you are holding some key position of the company and you happen to be a promoter or a founder promoter, then these shares can be issued to you. Okay, the SR share are issued only to promoters, founders who hold an executive position in the issuer company. So this is meant for only those people. Okay. Okay, further.
The issue of SR equity shares has been authorized by a special resolution passed at the general meeting of the shareholders of the issuer, where the notice calling for such general meetings is provided for.
So issue of SR equity shares have been authorized by special resolution. So there should be a special resolution which should be passed in a meeting of the shareholders for issuing these shares, which are carrying a superior voting rights.
The SR equity share shall have voting rights in the ratio of a minimum of 2:1 up to a maximum of 10:1 compared to the ordinary shares, and such ratio shall be in whole numbers only.
Okay, so the minimum ratio, the superior right ratio can be 2:1. So if some person is having one share, he will have two voting rights. Or it can go up to 10. 10 is to 1. If you're holding one share, you can have 10 voting rights, okay, 10 times than what normally you have, okay. So it can be in the ratio either 2 is to 1, which is the minimum, and maximum it can go to 10 is to 1, but it has to be in whole number. It can't be 9.5 is to 1, okay.
The SR equity shares shall be equivalent to ordinary equity shares in all respects, except for having superior voting rights.
So in all other respect, they will be same. I mean, like, getting dividends or whatever. So they will get the normal dividend as others get, but they will have a higher voting right compared to the others.
The total voting rights of SR shareholders, including ordinary shares, in the issuer upon listing pursuant to an initial public offer, shall not at any point of time exceed 74%.
So their total voting rights should not exceed 74%. Whatever rights they have. Suppose let's take an example here. Example, suppose a company has 40,000 shares. Okay. 10,000 is held by promoters who are eligible for the SR voting rights, and 30,000 are held by rest of the public. So total shares are 40,000. Okay. Now let's say these people are given 1 is to 10. Fine. Suppose this is given. So how many voting rights they will have? 1 lakh. And what is this? 30,000. So these shares will have one voting right. So 1,30,000. Okay. Now if you divide 1 lakh by 1,30,000, so what is the percentage of voting rights these people have, the promoters? How much? Just calculate. 76 percentage. Okay. How much they should have? So this is not, proper. Okay. So that means, it should be, 1 is to, say, 1 is to 9. Okay. So in this case, it will become 90,000, and this will become 1,20,000. Just calculate again. How much you get? 75. So this is also not acceptable. Fine. So they should be given 1 is to 8. That means, let's say 1 is to 8. So this is 80, and this is 1,10,000. Now calculate. 72. So that means if this is the share capital structure, then the maximum voting rights that can be given is 1 is to 8. So that the total overall voting rights held by this company should not go beyond 74. So if you look at the total voting rights of SR shareholders, including ordinary shares in the issues upon listing pursuant to an IPO, shall not at any point time exceed 74%. Okay. Remember this calculations. So the question will come. So you have to tell, what should be the ratio of the voting rights. It should not cross 74%. Simple one, okay. Maybe it will be part of your study. I mean the case study. Okay. Fine. Okay, read further.
The SR equity shares shall be converted into equity shares having voting rights same as that of ordinary shares on the 5th anniversary of listing of ordinary shares of the enlisted entity.
Okay, now all these shares after 5 years will have ordinary voting rights. So this privilege is given only for 5 years. So it has a sunset clause. That means after 5 years they will become normal shares. So that means the directors or the promoters who were given superior voting rights, this will end, okay, after 5 years from the date of listing. Okay, so it will happen from the date of the listing, not from the date when they are allotted or when the rights were given. From the date of the listing, 5 years will expire. Okay, so these are given 5 years. Now this can be extended for another 5 years. Okay, maximum. And but whenever the resolution is passed for extending, so they have no say on that. The shareholders who have the superior voting rights, they cannot vote in such kind of a you know ex, uh, provision meeting. Okay, read this.
provided that the SR equity shares may be valid up to for an additional 5 years after a resolution of to that effect has been passed, when the SR shareholders have not been permitted to vote.
Okay, so this is what I said, that they can be extended for another 5 years, but where the SR shareholders, they are not given, they are not permitted to vote. Okay. Okay, now we have the last two slides, pre-issue advertisement and post-issue advertisements. Okay, just read it.
The issuer shall, after registering the red herring prospectus or prospectus with the ROC, make a pre-issue advertisement in one English national daily newspaper with wide circulation, Hindi national daily newspaper with wide circulation, and one regional language newspaper with wide circulation at the place where the registered office of the issuer is situated.
So, this is a pre-issue advertisement. So the issuer shall, after registering the red herring prospectus or a prospectus with the ROC, the moment he has filed his red herring prospectus or the prospectus, the fixed price, then he goes and files a prospectus. If it is a book build, then he files a red herring prospectus with the ROC. Then he has to make a advertisement in all the newspaper, and here it will be all the summary of the offer document or the summary of the prospectus. Okay, either a red herring prospectus or a prospectus. So he has to make a summary. Then we come to the post-issue advertisement.
The manager or managers shall ensure that an advertisement indicating its relating to subscription, date of allotment, number, value, and percentage of all applications including ASBA, number, value, and percentage of successful allottees for all the applications including ASBA, date of completion of dispatch of refund orders as applicable, or instructions to self-certified syndicate banks by the registrar, date of credit of specified securities, and date of filing of listing
So that
application.
means, yeah. So there will be a post-issue advertisement which will talk about, about the share issue, giving details regarding how many people subscribed, what was the basis of allotment, how many numbers of shares were issued, including the ASBA, okay, and date of completion and dispatch of the refund orders, okay, and when the shares will get, be appear in the demat account of the shareholders who have been shares allotted to them. Okay, so all this needs to be given. Yeah.
Within 10 days from the date of completion of the various activities in at least one English national daily newspaper with wide circulation, one Hindi national daily newspaper with wide circulation, and one regional language daily newspaper with wide circulation at the place where the registered office of the issuer is
So
situated.
this ad is given, say, within 10 days from the date of completion of various activities. And this has to be given in all the newspaper which are mentioned here. Okay.
The above mentioned details shall also be placed on the websites of the stock exchange of the stock
So
exchange.
this has to be, placed on the stock exchange, the website of the stock exchange. Okay. So this completes the IPO. Okay.